Now let's look at the next chart. Now that comes from the International Monetary Fund. It's a measure of the savings rate and the investment rate. It actually doesn't matter to know which line is which. As you can see, the trend is pretty much the same in both. Now, notice Greenspan said that from the early 90s, this began, and then we had this big savings glut, too much savings, and yet, if you actually measure savings and investment as a share of world GDP, it was obviously bouncing up and down, but it was in a long-term downtrend. It was in a range that was lower between 2000 and 2005 than it had been between 90 and 95. Hardly a glut, although what was also happening, by the way, which we should acknowledge, is that there was some savings, a lot of savings coming in from the rest of the world to the U.S., but that was filling what was, according to Greenspan and others, a very low savings rate. And so what we had was more or less a balance. Savings came in for the rest of the world to compensate for the low savings rate. Although with that said, something else was happening. Other central banks around the world were doing something similar to what Greenspan was doing. They were fixing interest rates very low. That was indeed causing credit expansion, but credit expansion is not a savings glut. It's not something that just happens to you. It's not something that Greenspan might have been able to prevent it, at least mitigate it, had he raised the Fed funds rate, kept it high, kept it where Taylor suggested it would be. So that's Greenspan's rationales, and I think that they don't amount to much, and they're rather stunning in their brazenness, because he's declaring a glut. He doesn't want to look at a chart. He used to be a numbers man. He doesn't want to actually wrestle with the details of what went on, because amazingly, I've heard this savings glut phrase over and over again, even from sophisticated economists. Greenspan said it, there must be something to it, and yet there's virtually nothing to it. Nothing to the idea that something happened to him. He didn't do anything. There's no easy money policy. He's not to blame. It's all the savings glut. Well, we're going to deal with another brazen economist shortly, and that's Paul Krugman, but that comes in a minute. Let's go to the next slide. We're done in broad brushstrokes with the Federal Reserve. I wanted to talk about the government-sponsored enterprises, the GSEs, Federal National Mortgage Association, and the Federal Home Loan Mortgage Corporation. Now, probably what would have happened had we not had the huge participation of these government agencies, and that's what I'm calling them, but we'll explain in a moment what I mean by calling them that, then we probably wouldn't have had the severe credit bubble and housing crash that we did experience, had they not been huge players in this game. So I'm not necessarily going to lay it all on the Federal Reserve. If I'm going to lay it on government, let's share the blame around. Let's share it with the government-sponsored enterprises. As you may know, Fannie Mae was originally created as a government agency during the New Deal of the 1930s. It was privatized in 1968. It's a beautiful example of crony capitalism. It is a pure example of profits, of privatized profits, socialized losses. We pick up the tab if they don't work out, but if it does work out, the stockholders in these companies make out like bandits. The gentleman who made out especially well was a man. Let me make sure that I don't know why I forget his name for a moment. His name was Franklin Raines. He was the budget director under Clinton, and he walked away. He became chairman of Fannie Mae. He walked away with about $100 million in salary from these institutions. So that's what they did. That's who they were. They were both privatized, but also government protected. As you know, they are now being fully supported by the federal government. What did they do? Well, they were pretty much behind the subprime mess, or the non-prime, as it's perhaps better called, to catch other technical differences. All of those mortgages that were given to people who really shouldn't have been buying houses, who were never asked, no documentation was asked, everything imaginable in the book was waived. it was about the earliest we know is that it was about in September 1999 that that Fannie Mae and Freddie Mac began to get into purchasing subprime mortgages. I left out that part. They don't originate mortgages. They buy mortgages, which is great because obviously if you are in the business of giving out mortgages, you can sell these subprimes to these two massive 900-pound gorillas. I'm going to read to you what I'm calling a scholarly view. Let's go to the next slide. This comes from a professor at the Business School of Columbia named Charles Calomares. He wrote, "The politicization of Fannie Mae and Freddie Mac and the actions of members of Congress to encourage reckless lending by the GSEs in the name of affordable housing were arguably the most damaging microeconomic policy actions leading up to the crisis. In order for Fannie and Freddie to maintain their implicit, now explicit government guarantees on their debts, which contributed substantially to their profitability, they believed with good cause that they had to cater to the political agendas of their supporters in Congress." Unimaginable that these institutions could exist without the huge support of Congress, in particular Barney Frank, for example, whom we'll get to in a moment. Next slide. That meant, he continued, making a huge amount of risky subprime loans. Fannie and Freddie ended up holding $1.6 trillion in exposures to these toxic mortgages, which constitutes half of the total non-FHA outstanding amount of toxic mortgages. The federal FHA is also federal, and so we can set them aside. They were clearly involved as well, but their participation in the subprime mortgage market was massive. Had they not been involved, again, we would have had a very different outcome. I'll get to the next slide. I guess that's his final judgment. Without the U.S.'s uniquely large subprime shock, the global financial crisis and its severe macroeconomic consequences for the world would have been mild and short. So their participation was huge. But let's get to somebody else on Fannie and Freddie. Next slide. That's Barney Frank. In September of 2003, he was then ranking Democrat on the Financial Services Committee. He got upset because there was an initiative to try to bring Fannie and Freddie to heel, but he declared to the New York Times, these two entities, Fannie and Freddie, are not facing any kind of financial crisis. The more people exaggerate these problems, the more pressure there is on these companies, the less we will see in terms of affordable housing. Well, Barney Frank, I guess you could say, in his case, it was the cost of good intentions. The only reason why it's difficult to respect the man is because he won't own up to his huge responsibility in causing the crisis. Again, I would say that he's in a category with Bernie Madoff in terms of the pain he caused because of his political involvement.